I would address the speakers with some questions from our side and still start with Andy. Something that struck me is that you said in your analysis, you find that the valuation will probably decline by 10 to 20% in a 2-degree world. So what's the kind of assumption if we stay on the track of the 3.9-degree world that you showed on one of the slides? I assume it will be massively higher than minus 10 to 20%.
Well, so I should clarify, and I probably didn't make this clear, but so that risk factor is bluntly the risk of transition. It's the difference between the world that we're currently heading towards and the 2-degree world. We see unavoidably that the transition to 2 degrees will, in aggregate, and this is really important for today's companies, will be a cost. And that's not to say that there won't be opportunities. Many of those opportunities aren't yet listed companies. So what it's effectively saying, I think, is another way of thinking about this would be that a lot of the companies that are a large part of today's financial markets are companies that have been built on a system, an energy system or an infrastructure that is carbon intensive. And many of those companies will be at risk. And many of the opportunities will come from companies that we can't yet invest in. And what it's really saying, I think, is that we need as investors to be nimble. We need to look for those areas of new growth. And we need to recognize that the companies that have succeeded in the past may not be the companies that will succeed in the future.
As we've seen in other areas of technology, let's look at photography, for example, to quote an often used example. Julia, maybe a question to you. You mentioned that your next piece of research will be around the convergence of climate risk measures or climate risk assessments. Do you actually, what caused you to make this your next research question? Do you think that today's assessments differ from each other far too much?
Well, that's exactly the question we want to answer. We don't know yet. So, but there's wisdom, or we've heard of various concerns that people say, okay, if I use this tool or that tool, like I get very different results, and which tools should I stick to, or what should I do? And then in the end, that this fear of having very divergent results means that the information that would be available wouldn't be necessarily comparable or useful. So we thought it would be informative not only to us as researchers, but only to the market, to see whether the various tools provide divergent or converging results on the same portfolio. And then as a second step, to assess why this would be the case, if they converge or diverge. Our guess is that it very much relies on the scenarios you use. The scenarios, they do not only consider the targets itself, but also they differ a lot in the trajectory of emissions. Like, for example, when will be the emissions peak? When will be net zero? And this has important implications on the valuation of firms, because this very much determines to which extent assets have to be written off earlier than anticipated. This also has huge implications on the disruptive capacity or the disruptive potential of development. Second, in addition to the scenarios, we think that the depth of risk analysis might have a significant impact on the outcome, but we don't know yet. So we would like to have a look at that and see and provide recommendations what would be best practice.
Sounds very interesting, and who knows, maybe there will be an opportunity to present this to our members as well once it's ready. I have now one question from the audience to Andy. It's from Tamara Hardecker from SVVK, which is the Association of the Large Public Asset Owners in Switzerland. And your research shows the extent to which the fossil fuel sector is out of sync with Paris. Does this imply that Schroders is now actively underweighting all or part of the oil and gas sector to manage the risk across its holdings? Or how do you seek to address it?
So that's certainly the direction that we're going in. I think the way we look at it, just stepping back for a moment, is that there are parts of that industry that will find it very difficult to make a transition. So for example, coal mining companies, it's frankly quite difficult to see how there's a path from where they are today to where they will need to get to. So these would be companies where, frankly, the level of risk in those companies is very, very high. And the other way of looking at it would be that they would have to be therefore incredibly cheap, and in most cases cheaper than they are, to avoid that financial risk. But fundamentally, in terms of their consistency with sustainable outcomes and their transition, they're companies that, generally speaking, we avoid. There's then a group of companies in the middle, which are companies that will find it difficult, but can still transition. And this is really, I think, where something we haven't really talked about too much here, but the role of investors in changing companies. So, for example, if you look at some of the big oil companies and some of the commitments that they've made to change their business over time, that would be an area where, if we believe and we can identify that those companies have got clear commitments that are consistent with Paris goals, they have the organizational infrastructure or organizational processes to make that transition, and we believe that as investors we can engage with them and we can push them to make that change, and that we can monitor and track how quickly that is changing. We think one of the most important roles of asset management is actually about facilitating change within companies that will need to change. And so that's where I would say there is a distinction between the risk that companies face today, given their business, and how they're managing that risk by the way that they're changing their business. And so with fossil fuel companies, it's a bit of a combination of both. There are some where those risks are very high and unavoidable, and there are some where the risks are high, but could be managed by the companies themselves. And I think what we have, generally speaking, done in those areas is really make sure we're selecting or focusing on the companies that can change, and that we are very engaged as owners of those companies in trying to support them and push them and hold them to account in terms of how quickly they make that transition.
Thank you, Andy. And there's one last question to Julia, but I would like to ask you to keep your answer rather concise. It's from Andreas Holzer, Basel Landschaftliche Kantonalbank. He asks, on a scale from 1 to 10, where is roughly currently the average quality level of the tools you analyzed?
Yeah, so that's a tough question for researchers.
Tough question for the end.
I would say it depends. Rough guess would be 7 to 8. It has many elements that I have in mind. We can talk about that in person if you like.
Wow, 7 to 8 is rather high. So in other words, you say there is no need to further delay the use of such tools, as the quality is already definitely good enough to start with it. So this brings us, yes, this brings us to the end of this webinar. And I would like to thank all speakers for their contributions and the interesting insights they provided, both in the presentations and the Q&A session. I would also like to thank WWF for co-organizing this event with us, but even more so for commissioning such interesting research that definitely provides relevant insights to our members, but also to the broader public. And then I would like to thank all participants of the webinar. In case there is something you'd like to check up again, you will find the online recording on our website very soon. And I would like to make one other note also on climate risks, but from a different perspective. Swiss Sustainable Finance will soon publish an encompassing report on financing instruments for a low carbon economy, which is a slightly different angle, but we will illustrate the many different instruments out there. It will be towards mid-October that this report should be out. So check out our website for this. Now that's all from my side. I see the sun is out in most areas where our speakers are sitting, so enjoy the sunny day. And yes, I hope to speak to you again very soon. Have a good day.